Hello, everyone, and welcome to Currency Exchange, the NatWest podcast series all about foreign exchange markets. I'm Brian Daingerfield. I co-head G10 FX Strategy, and I'd like to welcome you to our Year Ahead 2025 edition of Currency Exchange. This is actually a weekly series where we talk about themes driving foreign exchange markets. And, for a lot of the time, we tend to focus on very short-term developments, but, this is the time of year when the market, ourselves included, collectively step back and think about some of the key themes that we think will drive markets over a longer term perspective. So to do that, I'm going to be joined by my colleague who also runs G10 FX Strategy with me over in London, Paul Robson, to discuss some of the big themes we think will be driving foreign exchange markets in 2025. But just to set the stage for how we think about some of the broader themes driving markets, 2024 was a year where I think it's fair to say that growth, and especially in advanced economies, held up better than expected, especially in the U.S., where the resilience of the consumer, the resiliency of the labor market was really quite impressive. And as we think about growth, and as we've seen stronger growth, you did also see inflation progress, although it was varied across major economies. And what that's allowed is for central banks to begin the process of dialing back restriction. And so 2024 was a year when markets were focused, if not obsessed, with the idea of when will interest rate easing cycles begin? Who will start first? Who will wait till later? For most major economies and even some EM economies, that question has now been answered. 2025, we think it's still going to be driven by the size and scope of these cycles, but maybe less about the beginning of the cycle, which has already been decided, and more about the end of the cycle. So relative interest rates tend to be very important drivers of foreign exchange markets, and we saw certainly in a major economy that relative front-end interest rate carry in differentials in policy rates had a really big role to play in the relative performance of currencies. And we think in 2025, we're going to see a similar backdrop where the speed, the scope, and the terminal rate, the landing zone of these policy rates is going to be critical. And so when we think about framing the year ahead, we're thinking about currencies where interest rates may end higher and easing cycles move slower, maybe set to benefit, while those that have seen growth slow down a little bit more, seen better progress on inflation, maybe have a bit more opportunity to become more aggressive in those easing cycles, and those may come under a bit more pressure. And so that's the framework through which we're really thinking about currency markets here. And first, I'll just start by talking about the dollar briefly, because the dollar tends to drive a lot of global currency markets. There was a period maybe a month and a half ago where it felt like the U.S. had an opportunity to maybe be a leader in terms of aggressive easing cycles. We'd seen meaningful progress in inflation, some signs of slowing in the labor market, and no meaningful expectation of a significant uptick in fiscal stimulus as a result of the election, maybe throwing a spanner in the works. But Trump's victory in the presidential election with united government has really changed that game, and it's actually pushed the dollar to 2024 highs as we record in late November, thanks to market expectations of higher inflation in the U.S., thanks to tariffs, wider growth differentials in favor of the U.S., thanks to the negative impact on global economies from tariffs, and also expectation of pro-cyclical fiscal stimulus, that Trump and Republicans will bring significant new fiscal stimulus at a time when U.S. growth has already held in better than most expected, ourselves included. So we think relative to where we thought we might be before the election, it's looking like it might be a more challenging backdrop for global currencies with a stronger dollar as baseline. Certainly that's a factor for global EM and for G10 economies as well. And so with that as sort of an overarching kind of picture, I'd love to bring in Paul here to talk about some of the currencies, certainly in your region, Paul. I want to start with European FX as a whole. What do you think are going to be some of the key themes there?
I think there's a number of key themes in Europe which are going to track quite well in 2025. There's quite a lot of currents across the region. I think it actually makes the outlook particularly difficult. I don't often want to say that, but I think you have to be honest when there are a number of competing drivers, all with different weights and likely impact. Some of them will be offsetting, and it's about the sequencing of those drivers. I think it's particularly difficult in the year ahead. If I think about the last couple of years, you've sort of had one or two key themes a year. We had COVID, we had which currencies had weakened the most through COVID and which ones were going to recover the quickest. You had the European energy shock, and that mattered. And some currencies did very, very poorly and then recovered as energy prices fell back. And as you quite rightly described, 2024 is all about, in my words, conquering Table Mountain. It was about the war on inflation. And once that war looked like it was won, it was about the easing cycle, and that was the dominant driver. And as I look to the year ahead for European currencies, I think it's about what does that peace look like after the war on inflation, and it leaves a number of key drivers across Europe. So you quite rightly talked about the landing point of the global monetary policy easing cycle, terminal rates. And in Europe, we have the whole range. We have some currencies that are going to have the lowest, and we also have some currencies that are going to have the highest. And I think that matters. That piece after the inflation war, it's left political instability in parts of Europe and stability in some other countries as well. I think that matters, most obviously for the euro, and it might matter for the UK. Fiscal policy, really quite badly impaired fiscal positions of a number of economies, and I think that brings risks to certain currencies like sterling, but that's got to be offset about again from terminal rates as well. And a couple of other key themes, one being domestic demand growth in a world where you have growing protectionism and pressure on trade. Maybe the economies that have the strongest domestic economies might do relatively well, and that plays quite positive for, say, someone like Sweden, which is going to be the strongest growing economy in the G10. And then finally, just current account deficit, surpluses, financing of that. Where does the capital flow? And I think that will be a key driver of European currencies as well.
So a lot of what you said definitely resonates with me, especially when thinking about the fiscal picture, because we're thinking about fiscal stimulus and changes in government having been a big driver in currency markets in 2024, and the aftermath of those changes look set to linger for sure in 2025, with most of those changes being towards more fiscal deficits, more spending, and potentially greater risks. The U.S., the exorbitant privilege of being the global reserve currency is something that maybe gives the U.S. a leg up, as fiscal positions in many major economies are showing signs of slipping further. So certainly a theme to watch out, but it's not just in the U.S. We've seen big political changes. You've seen, potential elections in Germany coming up, changes in the shape of government in Japan. And of course, in the UK, we just had the budget come through as well. So I do want to dig in a little bit on sterling, Paul. What are you thinking about sterling here as you're considering, its position?
Yeah, so we think the currency does relatively well in 2025. I still think the dominant themes for the currency, the ones that dominated this year, so relative growth, relative yield. But, and there's always a part when it comes to sterling, it comes with a little bit more risk. So what I talked about a year ago was this idea that Pacific risks around the UK had been greatly reduced, and it was more of a traditional outlook of monetary policy and relative growth. This year, and you mentioned, didn't you, about fiscal deficits, and the UK is running quite large fiscal deficits above nominal growth, and I think that brings risk to the outlook. If I think about how sterling performed last year, because of a slightly better performing economy, interest rates, Bank of England was a little bit more cautious. From a year ago, from our year ahead 2024, sterling was the best performing currency. Year to date, it's the second best performing currency. So I think those are the key drivers. And when I look at the Bank of England outlook, the UK is going to have the highest, I think, terminal rate across the major economies. And I think that matters. It's going to be quite expensive for people to try and sell the currency. Not so much it's when, maybe in emerging markets when interest rates are 8 or 10%, when it's very hard and difficult to sell a currency. But across Europe, I mentioned we're going to have some of the lowest in places like Switzerland, but the euro. So I think euro sterling, I think, is going to be really fascinating in 2025. But it's those fiscal risks that continue to linger. But I think that you start off in 2025 with the idea that sterling is going to be the carry king of the major economies, and I think that sets it in good stead.
Yeah, certainly the carry king within Europe for sure. But I think one of the things that has happened here in the U.S. with the changeover in the government and what that has mean is that the markets are now pricing in a risk that the U.S. joins the U.K. among the highest terminal rates in G10. And so similar dynamics here in the U.S. where it's just going to be very expensive to use the dollar as a funding currency. And so I think markets are going to have to be extremely convinced that there's going to be a trending move lower in order to have that confidence to get short the currency, to use the currency as a funder. And that's going to be something that I think for both sterling and the dollar may be a source of support here, is that the terminal rates are going to be or expected to be among the highest in the G10. So any other themes in Europe that you're focused on, Paul? I know you mentioned a couple at the outset. Any of the other currencies that you think could be interesting in terms of tradable themes in 2025?
Yeah, as I say, we've got a lot of cross currents in Europe, and we've got lots of different currencies that are driven in lots of different ways. But I think it feels like it's going to be hard for the euro to outperform in 2025. You've got that political instability. You've got pressure on the industrial complex in Europe. You put those together, and I think it's going to be quite difficult. Low terminal rates. I mean, we expect 2%, could be lower. Inflation's coming down quite quickly. If we get lower oil prices, for example, you've mentioned in the past about supply in sort of Middle East, but you might also get that out to the States as well. That would matter as well. So I think euro trades pretty weakly. Norway, I think there's two drivers here. One will be the lower oil price, I think, and that will really put some pressure on the currency. I think, especially for a market that seems to like owning the Norwegian kroner on interest rate expectations, lower oil price. But also, I think Norges Bank might just throw in the towel on its hawkish guidance. Inflation's coming lower. You don't need to worry about the exchange rate. I think that might catch markets out. And then Sweden, really quite interesting, fastest growing major economy in 2025 because of a leveraged economy, Riksbank cutting aggressively. Does that see capital flow back into Sweden? I think it does. So I think that currency might perform. The Swiss franc looks expensive, but maybe for good reason. The world looks quite scary place in 2025, and I think money will keep to Switzerland. So a fairly balanced outlook for an expensive currency that stays expensive for a little bit longer.
Yeah, the Swiss franc is definitely an interesting one when we think about the world of safe haven currencies, right? Because especially in G10, we're often thinking about the dollar and we're thinking about the Japanese yen in that context of safe haven currencies. And you have seen a massive divergence in terms of the favored safe haven currency among those two, Swiss franc versus yen. Now, this sort of trade of yen sort of taking back its mantle as a safe haven currency relative to Swiss franc, that's been almost a widowmaker in terms of foreign exchange markets expecting those old relationships that kind of come back here. But, Switzerland is an economy where we've seen, so I think like you said with Norway, where there's some expectation that the central bank might be more willing to allow some currency weakness. That's one where, as we're thinking about safe haven currencies, you tend to think about currencies with low yield. Japan almost certainly going to have the lowest yields, both in real terms and nominal in the G10. And I think that's going to be a challenge for the yen as we look ahead. We're going to likely see convergence in terms of relative yields because other central banks will be cutting. The Bank of Japan actually going to continue normalizing. We think they'll continue hiking. But I think the challenge for yen is going to be that it's still going to be among the most attractive funders because its interest rates are still going to be so low relative to the rest of the G10 space. So I think it's going to be a pretty challenging year ahead for the yen as well as we try and balance relative carry, which it looks like it's maybe shifting in yen's direction, against this reality that from an absolute carry perspective, it's still going to be extremely expensive to be long the yen in most expressions. I also wanted to just touch on a couple of other currencies in G10 that we'll be watching here, the commodity dollars, and some of the themes that we think are going to be driving those currencies, because we think we are going to see some differentiation. Now, certainly when you think about the Antipodeans, you always think about China and related risks. And if we're seeing the potential for downside risk for China, that has important implications for both Australia and New Zealand. But there's a relative monetary policy, relative growth story that's ongoing in these two economies where the RBA in Australia looks like they're going to be among the slower easers. They actually haven't begun their easing cycle. They're one of the few in global currency markets that fits that bill. Whereas New Zealand domestic growth there has really slowed down materially. And they've been moving more aggressively in terms of easing. And we think that trend can continue here. Canada also an economy where it looks like there's real room for divergence from the US because growth has slowed, domestic growth has slowed, and inflation has really come down. I think population growth, significant population growth, has played a big role there, but you just haven't seen domestic consumption be nearly as strong as in the US. And so when we think about the commodity dollars here, we do think Australian dollar probably best positioned among those, with New Zealand and Canada probably on the other side of the pendulum relative to the US and the UK, where improvements in inflation dynamics and slowing growth domestically probably gives them a bit more room to be easing more confidently, more aggressively. And we think that could mean downside risk for those currencies as we look forward to 2025. So with that, I want to thank you, Paul, for joining, and to our listeners, thanks very much for listening. If you enjoyed this podcast, please consider subscribing and giving it a like as well. This is, as I mentioned at the top, this is actually a weekly series. So if you enjoy this type of content, please give our channel a like, and we look forward to doing more content like this in the year ahead. Thank you very much.